In today's video, traders, we're talking about the NASDAQ 30, we're talking about the S&P 500, we're talking about trading the major US stock indices. Now, a lot of currency traders actually have access to this with their brokers through CFDs and that sort of thing. You can trade the NASDAQ 30, or you can trade the NASDAQ or the S&P. There's all different ways to trade this from other parts of the world. Now, this is a very unique instrument. The NASDAQ, the Dow, S&P 500, anything that tracks the US stock market or the index for these major markets is going to be a very heavily talked about topic. This is something that the whole world is watching. How the US economy has been a very, very big indicator for a lot of other things in the world, like the gold market, the currency market, the futures market, right? It's all watching what the US stock market is doing. And so today what we're gonna be doing is we're gonna be talking about how my personal approach to trading these sorts of instruments actually goes. And I do have a strong opinion here that I'm gonna share today in this video. So what we're gonna try and do here when talking about these major indexes is that we are going to take the approach of how generally we see markets behaving. Now, this is based on my research, based on my historical studies of this particular market. It doesn't necessarily mean that this is going to be how it's always going to be in the future, but what I've noticed generally with the stock market in the last 10, 15, 20 years of my testing is that, okay, the market tends to gradually climb, and every once in a while, what do we get? We get sharp declines, okay? Gradual climbs, sharp declines, okay? And we can see this on the chart. Let's scroll out for a moment and you can see some examples of this. We had some steady climbs here on the daily chart. And then what do we have? Sharp declines before another steady climb. So there are ways, in my opinion, to trade this on the short-term charts as well as the intraday levels. So this is something that when noticing, you can see here's another example. We had the steady climb, and then all of a sudden we got shoots to the downside, lots of volatility, climbs nice and slow, volatility. In 2018, the markets barely made any sort of gains. We just kind of were sideways. And so we can notice and recognize some patterns, and we can actually understand why these markets behave this way. Again, people ask all the time, Nick, what's the best way to trade the NASDAQ? And so if you're trading the NASDAQ or the S&P or the Dow, they generally, in my opinion, act similar, right? Because they're all kind of indices of the overall stock market for the US economy. Well, what we notice here is, again, we have those gradual climbs and those sudden drops in the stock market. And so a lot of times what you'll see is when the stock market or the NASDAQ or whatever you're looking at is climbing, people will be trying to short it along the way. People are trying to short, saying it's too high, it's got to come down. And although it very well can be considered overbought or overvalued at certain points, right? You could make the argument for that. My personal opinion is not to try and call tops, especially on these big indices that tend to, over the long term, climb. Think about it. The economy for the US and for a lot of the economies around the world is growing over time. The GDP is increasing. Technologies are getting better. Companies are able to do more. The standard of living goes up. This generally causes the long-term trend of a market to go up and up. It doesn't mean that it's always going to go up. There are times where we see serious corrections when markets do get overvalued. But generally speaking, the overall direction is to the upside, long term. And so with that in mind, my personal opinion is trying to short these markets is a losing game from the start. It's difficult. It's harder to short than long, in my opinion, on these particular markets. So trying to short is not necessarily something that I'm a big fan of. However, I will say on the back of that though, if I was to short, let me show you what that would kind of look like. If I was looking to short a market like this, right, the index one, I would take the approach of probably being late to the party on the short side and early to the party on the long side. What I mean by that, let me just give you a very simple example. If we have a market that looks like this, if I'm looking to get long, I'd probably want to be more interested in buying dips. Even if I'm early to the party, right? If I bought a dip here, remember, generally speaking, I think the markets are more likely to go up over time, right? So I could be buying here and waiting for the overall climb. Now, this could take a lot longer than I expect, and there's times in 2008 where you wouldn't have seen the return for a long time. But generally speaking, I'm looking to buy the dips and try and get early on in a pullback compared to when I'm short. Let me show you where I'd be looking to get short on this example. In the short example, I'd be okay to get in late, right? Because trying to get in early on the short side could mean sitting here and holding on to losers for a very long time without the promise or any sort of guarantee that the market will eventually come down, right? There's no guarantees of that. So we could be sitting there and holding, as many people have done all over Wall Street, trying to short and say, oh, the market's too high, the market's too high, and it just keeps going up and up and up. So to me, that's a losing game. That's not what I want to do. If I'm going to look to short a market, to me, it would seem more logical to do so when weakness is showing itself in the markets. Meaning that, okay, well, here's an example of the nice trend to the upside. When that starts to break down, maybe there's some sell side setups along the way down. Trading pullbacks, trading breakdowns, there's opportunities there to trade the downside as well, but I would rather be doing so in a market that looks bearish and that's starting to come down and showing downtrend structures rather than trying to do so on the way up, right? So if I'm shorting, I'd rather short on the way down rather than short on the way up, if that makes sense, right? A lot of times people who are trying to short, they're trying to do that. So trying to short on the way up. I'd prefer to short on the way down. Obviously, in hindsight, that's perfect. And sometimes, it works out, but not always like that, right? So sometimes you short and the market continues. Take a look at what we just saw recently on the NASDAQ. You can see we had a short or some volatility come into this market. We saw price start to roll over, and sure enough, we actually caught the bounce and things didn't really ever get going. My idea actually in this area was that I thought we could see some further downside. We were not correct about that, obviously. Now you can see price is continuing. So again, it is very hard to be on the short side, in my opinion, with these major index funds, right, or indices. When we're trying to be on the short side, it's very difficult, especially in a very bullish market. You have to understand when trading these, the market environment that you're in. Are you in a major bull market like the one we see, where price is significantly above the 200 period moving average and overall things are very, very bullish? That can be hard to short into. But if you want to go long, that's the other side of the equation. How do we go long? How do we buy into a market that's doing this sort of thing? Well, my personal opinion is to look for dips, look for pullbacks, and to trade the dips. As for the long term, this has been very, very successful. If you've been trading dips and buying and selling on dips on the last 10 years, this has been a beautiful strategy. Imagine if you were just buying dips all along the way here, buying, selling, buying, selling, buying, selling, right? That's a beautiful strategy, and that will not always be the case, right? It's not 100% foolproof, but along the way, it's been a very good strategy. And until the bull market kind of finishes or changes directions officially, well, that's been a strategy that's been a winner. And so for me, in a bull market, that is kind of my bias, is not to try and call tops, but rather just to work with the dips and get out if you're wrong, but let it run if you're right. That's really where I find the best way to trade this. Now, I don't trade these indexes or indices because I trade stocks, or I invest in stocks in the US. I have access to the US equity market, so I can trade the indices there, or I can trade individual stocks. But for me, I find that it's better to be on the long side at a good discount rather than trying to short companies that are gaining in value, or the index which is gaining in value, right? I find that to be a very difficult and losing game, something that I personally stick away from. Again, at the end of the day, people will have their own opinions of what is best, and this is mine, right? I'm sharing my personal opinion on this market. Of course, when we have a bull market like this, it's hard to try and say, that it's going to come down or it's short here. It's going to look stupid to try and short in hindsight. Going forward, that could change. Let me show you an example of how, maybe I'd change my bearishness or my bullishness to bearishness. Let's say we started to see a correction and we actually started breaking underneath some structure like the 200 period. This might actually get me involved in the short side, looking for downfall or downtrend continuation here on the US markets. So that would be kind of where I'm looking. So, well, we've talked a little bit about the swing trading size. Let's really quickly take a look at the shorter term charts. A lot of what we see in the Dow, in the NASDAQ, right, is we see The intraday sometimes has some nice little trends to it, but for the most part, you can see the gap is always kind of an interesting thing. So in the currency market, we probably won't see this gap, but when you're looking at the actual NASDAQ trading on the stock market, right, you'll probably see gaps like this, and you'll see, you know, the market gaps open. A lot of times the market fades. So there is the concept of gaps. Sometimes you get gaps where they continue, right, where they don't stop and they just continue in the direction that they went to. So watching those gaps can be an interesting thing. What I find is that, you know, of course, in a bullish market, these gaps look like they tend to fill on the long side, and when they gap up, a lot of times they just keep going. So that's kind of the nature or the essence of a bullish market. So there is some intraday concepts that you can trade, in my opinion, on the NASDAQ, on the Dow, the S&P 500, and it really comes down to understanding the nature of the day. For example, in this day, price was very consolidated. We didn't really break out very much. But then you have days like this where price gaps up and it continues, and there might be continuation plays to trade during the intraday timeframes. So just something to play around with, something to think about. This is my opinion personally, again, on the NASDAQ is mostly I'm looking to get long on the trend continuation. And if I'm getting involved in the short side, I'd rather be late than trying to get in early. So I'd rather be looking to short a continuation to the downside rather than trying to short on the way up, which is a difficult game. That kind of wraps up my thoughts here. Let me know what you think about it down below in the comment section below, and we'll see you guys back in the next video.